we have seen several headwinds from 2025 turning into tailwinds, and that was why 3 months ago the 2026 outlook of my team is that we are bullish. We think that GDP growth this year will be over 2.5%. At the same time, while core PCE inflation will be coming down below 2.5%. However, I will have to say, Adam, so now we are a little bit more than 2 months into the new year.
Mm-hmm.
I am becoming more cautious about our bullish outlook.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The jury's still out for many analysts on the outlook for economic growth, inflation, and the labor market this year. Some see lots of reasons for concern in the road ahead. Others are much more convinced that 2026 is going to be a blockbuster year. So, which is more likely? To find out, we've got the good fortune to talk today with Dr. Anna Wong, Chief U.S. Economist for Bloomberg Economics. Prior to her current role, Anna also worked at the Federal Reserve Board, the White House Council of Economic Advisors, and the U.S. Treasury. Anna, thanks so much for joining us today.
Happy to be here again, Adam.
Well, thank you so much. Happy 2026 and happy Valentine's Day. I think when we're recording this the day before, when it airs, I think it's going to be the day after, but I hope you and your family have a great Valentine's.
Thank you.
All right. Well, look, I got a lot of questions for you, most notably about economic growth, inflation, and the labor market. But why don't we start, Anna, just with what's your general macro outlook right now? I kind of talked at the beginning there that, there are lots of reasons that a lot of people I talk to are kind of concerned for 2026, but there are a lot of reasons why people think that, there's reasons to be pretty optimistic here, especially if you listen to the administration. They think a bunch of tailwinds are coming. So what are the most important trends you're looking at right now when it comes to the macro landscape?
Yeah, so if we look at the U.S. economy from a very high level just thinking about broad macro forces, we have seen several headwinds from 2025 turning into tailwinds, and those are reducing trade policy uncertainty, including fiscal impulse turning from contractionary to expansionary. And then we also have AI productivity showing up in productivity data already. And also credit impulse is also changing because of the deregulatory effort that the administration started last year is going to start affecting lending patterns of small to medium banks. So, I mean, these forces, just to name four, should be adding to growth this year. And that was why 3 months ago, the 2026 outlook of my team is that we are bullish. We think that GDP growth this year will be over 2.5%. At the same time, while core PCE inflation will be coming down below 2.5% because of both a combination of productivity growth and also these strong headwinds turning to tailwinds. However, I will have to say, Adam, so now we are a little bit more than a month or a month and 2 months into the new year.
Mm-hmm.
I am becoming more cautious about our bullish outlook. There are a few things that has happened that made me a bit more concerned of downside risks to the economy. The first thing is the sentiment around the AI investment seemed to be more fragile. And last year when one of the that I got a lot was, how do we know we're in a bubble, and how do we know it will pop? When will the AI bubble pop? And my answer consistently has been, it would happen when firms start to discount, start to lose their monopolistic edge over the AI specific product they sell. So what we are starting to see earlier this year is, and it's quite similar to what we saw last year in the beginning of the year when DeepSeek came out with this seemingly more efficient model than the US is that you have, it seems like firms within the US in the AI space are almost like competing more of each other, and therefore each of the firms are losing that markup. And when when firms lose that markup, it's actually great for innovation adoption, because then more of other firms from other industries can adopt it. So for the real economy is actually good. However, for the stock market, since the stock market, the valuations has been concentrated, the rally has been concentrated in these handful of firms, hyperscalers. If there are any doubts about, whether these firms can maintain their margin, then you start having a stock market correction. And I think I'm seeing a little bit of that enhanced competition among the various, key companies of AI. And
Hmm.
so and in my team, we had run a model simulation of what happens if the stock market were to uh, correct by 20%. And that would produce a drag on GDP growth by about zero point 0.7 percentage point. So, I mean, so our baseline for this year is GDP to grow above 2.5. I believe we have about 2.6 or 2.7. A zero point 0.7 percentage point drag to GDP growth still would produce a 1.9, 2.0 GDP growth, but which is still very, very respectable, especially when you compare to the potential GDP growth rate of about 1.7 to 1.8%. But nonetheless, I think for, for many people whose wealth came from asset prices,
Hmm.
and if you do have this top line asset price correction, then you could see, this 30% of the US economy would feel the pinch from a stock market correction.
Hmm. So that sort of the top half of the K, which has been doing a lot of the
Yes,
spending, would be
exactly.
impacted by that, and they would start reining in their spending a bit.
Exactly. But let me just to be clear, the zero point 0.7 percentage point drag on GDP growth, that is assuming that equity market correction does not spill over to the credit market. So now, if this correction become more broad-based, where particularly, say, this correction also led to, part of the story of how this AI investment of hyperscalers continue is that they have been issuing all these bonds, right? So if these if the AI investment bust leads into this credit market and you see widening credit spreads, then that will actually lead to a much bigger GDP drag, say 1.3, 1.4 percentage point. And so that would cut our GDP growth outlook by half
In
if
half.
that were to happen.
Got it. Okay. Um, all right. Were there other reasons that you were becoming more bullish, or was that, I think you mentioned four, but was that kind of or were those the four breadcrumbs you just connected there?
Yeah, yeah. I mean, I would say those four are the biggest one. But there are,
Okay.
of course, there are other things such as deregulatory, broadly speaking. And from earning transcripts, we have seen that some firms in certain sectors, such as oil and gas, have been talking about how the relaxation of environmental standards have accelerated, caused them to accelerate the investment. So we are seeing, various uh, regulatory um, headwinds turning into tailwinds for specific sectors. But that's like more of a minor story. I think
Yep.
the top four factors that I named are by itself pretty, substantial already.
Right. And I'm sorry, do me a favor. I've been furiously scribbling notes. On the four positive things, it was the AI productivity starting to show up, the credit impulse from the deregulation. What were the other two again?
The uncertainty coming down, and this is uncertainty broadly. So
Like
trade
trade
uncertainty,
uncertainty?
yeah,
Yeah.
trade uncertainty coming down, geo-economical, political uncertainty coming down, economic uncertainty coming down. And the fourth one is fiscal impulse, turning from contractionary to expansionary.
Okay. All right. Um, okay, so uh, there have been lots of reasons to make your team feel like, hey, yeah, we're actually going to take the upside on 2026. But you're now that we're a little bit into the year and you're seeing what's happening with the AI, you're worried that that could potentially not ruin the party, but put a damper on things if the fragility in the AI space leads to a market correction. And obviously, if that then bleeds into the credit markets, it could be even worse. I totally get all of that.
There are also other reasons why we are suddenly more cautious about our bullish outlook. There are
Okay,
others. Do you want
let's
me to
yep, let's
name
hear
it?
it. Bang them. Yep.
Yes. So, when I speak to clients, one question I get a lot is they're wondering about all these policies coming out of Washington, D.C. And it, it it seems that the lingering uncertainty and the lingering risk to this bullish outlook would be coming from Washington, D.C. And we are seeing a similar message from earning transcripts. The top macro theme that we extracted using very sophisticated AI technique from this current season, earning transcript season, is concerns about government policies. So some of them are the credit cards cap. I thought that the credit card caps could produce what could be one of the biggest possible self-sabotage that
Hmm.
the administration can do to itself. And because we have seen how this would end in early 1980s, President Jimmy Carter also imposed credit interest rate caps, and that led to a contraction of credit availability. Because if banks could not charge what they need to compensate for the risk, of course they're going to reduce
Right.
credit availability.
Totally
And
makes sense.
right, so that's one risk. Um, Second risk is who would have thought that President Trump would pick a well-known hawk as the next Fed chair?
Hmm.
I mean, and I think Kevin Warsh nomination um, it, w raises the possible tail risks of either end. Either he could be very dovish in the near term, and then ultimately he has to raise the interest rate. I mean, if you down in 2027 or even 2028 after the presidential election, say if a Democrat wins the presidency, well, 2028 and beyond, we'll probably will see a tightening of policies. Or on the other hand, if we see the version of Kevin Warsh, which was very much present in the FOMC minutes from 2006 to 2011 when he was a Fed governor, then we will see a actually very hawkish Kevin Warsh, and a Kevin Warsh who would want to shrink the balance sheet, which could, if done wrong, could raise the long-term interest rate.
Hmm.
So either way, I think Kevin Warsh nomination raises the risk to the outlook. And fundamentally, what it was is that his nomination injected some kind of policy uncertainty from the Fed. And perhaps this policy uncertainty translate into a higher equity risk premium. And you could see that the risk assets correction was partly catalyzed by Warsh nomination.
Hmm.
Um, and so I think these two policies, the credit cards cap and the Kevin Warsh nomination, to me raises the risk of tail probability.
Okay. I've got actually all these on my list here of things to talk to you about. So I want to pull on those threads with you here. Real quick, let me get back to the bullish side just for a moment. So we're hearing a lot about from the bulls, about reflation, which I think simplistically can be thought of as higher economic growth but contained inflation, right? Um, I'm curious to get your thoughts on where you see inflation going from here. My guess from what you've said is you probably take the under on it, right? So, and you're nodding as I'm saying this. I'll give you a chance to comment on this in just a second. But yeah, in a reflation trade, you're not really expecting inflation to go up. Um, Obviously, if you got the AI market correction that you thought, and especially if it spilled over into the credit markets, all of that would be pretty deep, disinflationary for the economy. But even just sort of assuming that doesn't happen for a moment, um, we just got the headline CPI numbers this morning, right? And they're down at what, 2.4?
2.4% for headline.
2.4%, yeah. And I've been talking with a bunch of folks on this channel over recent weeks, months, et cetera, that it's kind of hard not to expect headline CPI at least to continue to disinflate because of what's going on in housing. The shelter component is by far the biggest component of the CPI calculation. And by all accounts, and I've got an interview coming out, I think a day or two after this one, Anna, a deep dive into the real estate, the housing market. And I mean, demand is the lowest that it's been really almost forever in the data series, and rents are clearly disinflating in the country. So as long as that continues, that's going to be pulling that shelter number down, and the shelter component in CPI is very lagging. So it has been sort of artificially kept it propped up, but that's now starting to, the data is catching up to the CPI. So it seems like unless there's really strong inflationary impulses elsewhere in the CPI basket, which I don't think we're seeing, I think just sort of general math should lead us to expect some further disinflation here throughout 2026, you know, barring anything changing. Do you feel the same way?
So I have been nodding because I agree with the assessment that at least in the next couple months, the my baseline is that inflation will be coming down rather than coming up. But I kind of disagree with the reasoning for why
Okay.
this is happening. I mean, because if one were to just appeal to the shelter argument, you then you're missing a lot of the what's happening in the economy. That's holding things in either way, in the
Hmm.
inflationary way as well as deflationary way. And also, even though shelter has the largest component, recall it is the monthly fluctuation that drives month to month inflation and
Hmm.
drives what the Fed sees, right? So the shelter component is super slow moving. So even if it were to continue to disinflate according to its own gradual pace, each month it's not the delta that's pushing the month-to-month CPI higher or lower. So what is really causing the explaining the month-to-month fluctuations in inflation are things like apparels, goods, sporting goods, audio equipments, and on the services side, recreational services like admissions, sporting tickets, airfares, hotels. So I will tell you what I see there. So first of all, our team's view is that inflation is trending down because we have observed that the pass-through to tariffs has peaked last fall. So we have been tracking millions of online prices and using corporate big data. And what we have found is that the tariff pass-through started contributing to core goods inflation around April of last year. And I would say in total, the tariffs pushed up core goods inflation, but or overall core CPI by about zero point 0.3 percentage point for the entirety of last year. At the same time, the tariffs is an income shock, a negative income shock to the
Hmm.
economy, and so is fiscal. So what you saw last year was offsetting that tariff-generated inflation is services inflation coming down. Because recall from Liberation Day on, the stock market corrected, right? So income growth and discretionary services was actually deflating in a few months. And now we know after the jobs revisions that the summer of 2025 hiring was negative, was really, really bad. But what happened after the Fed started cutting in September was that we are starting to see services inflation picking up again. Hotels, airfares, things for which people that tend to correlate with whether people feel wealthy, perhaps from stock market wealth, those were going pretty strong. And even in today's, not today's report, in the January's report that we saw a couple days ago, because Adam, I'm timing for when your thing released, so it will be a couple days ago.
Okay, thanks.
So we have seen in the January CPI that the things that are strong is the whole exactly it's airfares, sporting tickets, 5% inflation, 1 month inflation, sporting tickets, uh, um, car rentals. So things where people would only do when they feel wealthy, those are strong. And I think that so as long as the stock market keep going or keep growing at, you know, 10 to 15%, I think you will likely see some strength in recreational services. Those are what's propping inflation up. At the same time, you still have, even though we think that tariff pass-through has peaked for many of those goods, you're still seeing some stragglers, like um, I would say toys. Toys is a good example.
Sure.
Because toys, they barely have built up the inventory last year, and then the small businesses have depleted their inventory for toys after the holiday season. So at some point this year, they're going to have to rebuild their inventory at a higher price level because now they're out of inventories and they have a higher tariff. I mean, in a way, this completely explain why suddenly there are some news rumor of Trump talking about uh, uh, holding a tariff truce with China because I think they have to give room for Walmart and Target to import a whole bunch of goods from China at lower tariff rate before they raise it again after they're done stocking up for the next holiday season or back to school season. There's actually a pattern to Washington D.C. tariff policy to like, you know, when Walmart and Target and Home Depot are gonna stock up their stuff. So anyway, so I think the uh, upside risk continues to be these discretionary items, whether the stock market continue to like chug along, then as long as it is, then those items will be moderately strong. And on the disinflationary and deflationary side, aside from shelter, what we are seeing is some of the supply shocks, adverse supply shocks from last year is starting to go away, such as, the avian flu, the screwworm, which have pushed up eggs and beef prices. Well, those
Hmm.
are going away. So you're seeing this mean reversion of prices in those category, which is leading to deflation looking trends. Um, I will also say that one thing we are keeping an eye on the upside inflation risk is AI induced supply chain risks. So in the January CPI, we saw a massive increase in computers prices. And this is consistent with, and I mean, you just need to go to Best Buy and just look at computers, iPad prices. They're going to be increasing very sharply. Why is that? Well, because with the AI investment boom in data center, there is this surge in demand for memory chips, RAMs,
Hmm.
and a big company called Micron, which is a big player in producing RAM for consumer electronics. They are diverting their production to these data center. They're cutting back on producing RAM for consumer electronics. So suddenly you have this serious shortage of consumer electronics chips, and that is pushing up electronic prices. So that's a supply shock. That's a new inflationary supply shock. Um, um, I think that could be but all in all, despite all this various interesting stories that's behind this inflation print, on net, we do see core CPI and core PCE gradually coming down to below 2.5% by the end of this year.
Okay, great. And that's what I was going to ask for. So it's a complex situation with a lot of different cross currents, but you think in general the disinflationary components will slowly win out throughout the year. And that's if everything kind of hangs together. You'll take the under, I imagine, if this AI fragility starts creating market corrections and stuff like that that you mentioned earlier.
Yes, I will mention one more upside risk because I think you and I are both clear on what could further amplify the deflationary risk, stock
Yep.
market correction. So let me just play the devil's advocate on the upside inflation risk. World Cup. So World Cup is coming to America in July, and we have seen that like I think 10 US cities are hosting these games, and these games pack the stadium, right?
Right.
Like 15,000 people. And recall what happened in the fall of 2023. Do you remember what happened in the fall of 2023, Adam?
Oh, I'm trying to remember back. Enlighten me. I'm not gonna pull the reference.
Taylor Swift happened.
Oh, okay, yeah, the Eras tour.
Remember, it's like wow, GDP growth was suddenly 5% in like third quarter of 2023. What happened? Oh wow, Taylor Swift happened.
Hmm.
She was giving these packed stadium concerts to like, and on average, each person who attended Taylor Swift concert spent like $1,500. And now we see that on average, a person who attends World Cup spends $2,200.
Dollars, yeah. And it's
And
not just on the tickets, it's on their
no,
airplanes and their
on
hotels and their food. I mean,
exactly, exactly,
it's really boosting
exactly,
the overall economy. Yeah.
exactly. So in the way that these prices show up in the CPI is that typically in the CPI airfares, people buy the airfares about 2 to 4 months before their actual travel. So if the games are in July, then it could possibly start showing up in April to May in the airfares. But it could,
Okay.
I mean, I know a lot of people who plan to travel in summer who are already buying their tickets now. So it's also kind of not surprising that airfares are going very, very strong right now. And, you know, um, California just raised the minimum wage last year, and the hotel industry was talking about how the higher minimum wage would drive many hotels out of business, and especially on the cusp of this huge demand shock from World Cup, that they wouldn't have enough capacity to host all these people. So I think given that we have seen a real macro impact on GDP, spending, inflation from Taylor Swift, I think a World Cup event would produce similar kind of situation.
Kind of situation.
Yeah.
Okay. And that's, I mean, all right, yeah, that'll maybe push CPI higher than it would otherwise, but it's also a real stimulus to the economy. So it's not a bad thing necessarily, right?
It's not a bad thing, but if it both push up inflation and GDP growth, then there will be less of a case for Fed rate cuts, right?
Yeah, yeah, I guess you could say that.
And
Um,
if there's less of a chance of Fed rate cuts, the market would not like that either as well.
right. Um, True. Although right now the market's not pricing that many rate cuts in for this year, right? I mean, aren't
I think
they?
they have almost seven. I mean, sorry, 75 bips. They have almost almost three 25 bips priced
Oh,
in.
really? Okay. Last time I looked, which was admittedly a week or two ago, I think it was like two. So that's actually risen since the Warsh announcement?
63 bips right now.
Okay, 63. So a little bit more than two. I would say,
Two and a
rate
half.
rate cuts
Two and a
haven't
half.
really done all that much yet. I mean, we've had a bunch of rate cuts and they haven't really done a ton, but still, I get your point. So, all right, here's some of the dots I'm trying to connect here. So, we could have a year where the economy does quite well and inflation disinflates. Maybe not dramatically, but inflation, is becoming less of a problem, right? Um, and to your point about concerns about AI, we may have a year where that happens, right? Strong economy doesn't necessarily mean strong markets, right? And this is a
Exactly.
message I've been trying to get out there
Exactly.
to folks. Don't know if it's going to
Exactly.
happen, but just be open to this, right?
Yeah,
Where
exactly.
economy surprises to the upside, but markets might disappoint, right?
Exactly.
Um, okay, and your
The
default.
sweet the sweet spot, Adam, is that
Mhm.
the the economy is not super hot and the labor market is not super hot and it's just a little bit weak enough to get the Fed to
to
start
get
cutting.
the Fed. Yeah,
That's the
exactly.
sweet spot.
That's the
Yes.
sweet spot. So here's where I'm going with this. So you talked about Warsh getting appointed as Fed chair, and you talked about what I'm going to call government policies gone wild, which is just like, you know, the administration increasingly coming out with these things that make you go, whoa, wait a minute, right? Like, what's that? You're going to cap credit card rates, or you're going to uh, you know, there's been a number of housing market policy trial balloons that have been tossed out there. But the reason why I'm mentioning all this is a mid-year election, right? And so to your point about, helping Walmart restock and whatnot, this is my opinion. You might have a different one. Wouldn't surprise me at all if we did that, right? But less because we want the shelves to be stocked with cheap toys at Christmas, although I'm sure Trump would love that if he could get it. I just think he wants whatever he can get done to make people feel better about their personal economic situation
Yeah.
when they walk into the poll in November, right? So
Yes.
we're probably going to get more of these as time goes on, right?
Yeah.
And whatever we can do, all right, I gotta put a moratorium on tariffs with China just so I can, get cheap stuff on the shelves by back to school time. I totally get that, right? And I think we'll probably see more of that type of thing. You're nodding as I'm saying this, so you're sort of expecting this too?
Yeah. Yeah.
Yeah. Okay. Let me ask you this.
Well,
Um,
I will just caveat
yeah,
that by saying there are always unintended consequences to populist policies.
absolutely. I just don't think that he cares. Meaning, like, I get it, Anna, but we'll deal with that after the election. Like,
Yes.
as long as if I can manage to hold on to Congress, I'm happy to take whatever unintended consequences come from here and just figure it out later on, right? I know you're not a political analyst. What do you think of the odds of the economy getting to a place by November, by whatever unnatural acts they might do between now and then?
Unnatural.
Yeah. What do you think? What do you think? What odds do you give it that they can get it to a point where people are like, yeah, I'm actually starting to feel a little bit better, right? Better enough that, yeah, it might actually influence my vote.
Yeah, Adam. So, as you said, I'm not a political analyst. However, that said, we do put out these pieces that correlates economic outcomes to midterm elections voting behavior. And in these pieces, we often reference a thing called the misery index. And the
Yep.
misery index is constructed by adding inflation to unemployment rate. And it's in the past, it seems to have um, have a correlation to by states, by how each state votes.
Yep.
And also, you probably have heard of the Ray-Fair voting model. So Ray-Fair also has this formula based on economic inputs like GDP growth in, I believe, is it 3 quarters before the midterm, a few quarters before it is all it matters. It's not about the third quarter or the fourth quarter.
Oh,
It has
interesting.
to be, there is a long lag time. Basically, it has to be April. Like
Yeah.
that, like it has to be getting better fast. Um, so so I think yeah, one would think about whether the administration can bring the unemployment rate down. And I would say that they have a fairly decent chance of doing so. So our baseline outlook for the unemployment is that it will stay elevated at 4.6%. um, throughout this year. Um, and what informed us on that was that we were expecting a little bit more of labor force participation because of the introduction of work requirement from the One Big Beautiful Bill.
Mm-hmm.
And so when you have higher participation, you will probably need increased job hiring in order to fill those jobs. And second, we also think that AI is the labor productivity enhancing impact of AI will be showing up this year, and that could lead to sustained tepid hiring.
Yeah.
So that's why we kept it at 4.6. However, now we saw in the past week's payroll report, um, it was a very decent payroll report. And what the payroll report shows is that the break-even rate is the monthly pace of hiring that is needed to keep the unemployment rate steady. So the break-even rate seems to be 15,000 per month. And on a 3-month moving average basis, hiring right now, according to the BLS report, if you take it at face value, is
Mm-hmm.
73,000. So it's higher than the break even. Now, of course, the BLS report is likely overstating the
Mm-hmm.
actual hiring. We think that, in fact, the 3-month average is probably somewhere between 30 to 40,000.
Okay. But still materially better than break even?
That is still higher than break even. So if that
Hmm.
continues, you are going to have probably a declining unemployment rate. But I think that to make people feel really happy, I think it has to come back down to 4.1 or 4.0 to make people feel like, oh, I can actually quit my job and find another job,
Mm-hmm.
but because right now the atmosphere in the labor market is like, I should hold on to my job. And if you don't already have a job, it is very, very hard to find a job.
Yeah.
And that is the kind of feeling that Trump has to dispel in order to get people to want to vote for him.
Mm-hmm. Well, I'm curious with all the, you know, we're building factories, we're building data centers, we're reshoring manufacturing, we've got all these other countries that have promised to bring a bunch of capital here and employ our workers and stuff like that. Do you think that can make a difference? Is there enough time for that to make a difference?
Okay, so those things indeed take many years. So I will say that most of whatever impact that has, if there's positive impact on those policies, will be after the midterms.
Okay.
It will happen probably by 2028. However, I have to say that in the most recent jobs report, and in fact in the last couple jobs report already, I am seeing some inklings of this. So, for example, in construction, you would think that with the housing market being icy cold, that construction hiring would be falling, but nope, it's not falling because you also see that non-residential construction hiring is picking up because of data center uh, construction.
Right.
So
And
as
sorry to
long
interrupt, but is part of that too the fact that maybe uh, a lot of like construction jobs were going to undocumented immigrants, and we have less of them now, and so they're hiring more American citizens for those jobs who get counted?
so I would almost feel like um it's basically converting people who would have been in the residential market to
Hmm.
building in a non-residential market. Because,
Okay.
for example, an HVAC company that would support residential houses is suddenly, you know, in demand for non-residential HVAC, the water
Hmm.
cooling things. And I would say that generally, uh, undocumented immigrants are not well captured in the
Right.
labor survey. So now that they are there are less of them, that they also shouldn't be showing up more or any because they were not captured in to begin with. So no, I don't think we're seeing much of it. I think more of it is that we're just seeing people who would have been working in the residential construction sector moving to non-residential
To
sector.
non-residential. Okay, okay, yeah. And I don't want to rattle on this, but what I was thinking is if you have a certain employment rate, but that is maybe a little depressed because you're employing people that you're not reporting, and
Sorry.
then you have no worries, and then
Sorry.
you have less of those people around, and so the jobs have to be filled by people who are getting counted. That would actually make the employment numbers a little bit better. But whatever, we can. It's not that material here. Okay, so at a high level here, um, well, I guess I'll
Oh,
go here to,
one
yeah,
more thing, Adam,
yeah, yeah.
on the manufacturing, the impact on manufacturing. So we see overall manufacturing hiring has come down ever since the tariff shock. And however, in high level macro models, one would see that the impact of tariff on IP actually in on production, meaning um, last about 12 months at the until the peak, hitting the peak drag. And I think I'm also seeing in the jobs data this turnaround in manufacturing, almost like the worst is over.
Is
And I'm
over.
seeing some pickup in metals production. You know, the industrial metals sector is where um, these tariffs were supposed to really boost domestic production. It seems to be happening. The issue is that the increase in these jobs might be more than offset by decrease elsewhere, you know,
Hmm.
as a result indirectly from the tariff. So,
Okay.
yeah.
So let me, at high level, let me ask you this. Um, you're not a political analyst, but what do you think is the likelihood? What do you think is the likelihood of the midterm elections being influenced by changes in the economy between now and then?
I yeah, I think the chances would be in terms of the outcome that would be favorable to the administration, the chances would be low. But in terms of things that could happen between now and then that would be unfavorable to the administration, that's higher because people
Yeah,
tend to be driven more by negative things. You know,
sure.
if your 401k decreased by 20%, who would you be angry at?
Right. Well,
Versus,
if we get your kind of breakdown in the markets because of AI, and if it were to bleed into the credit markets, I mean that's going to please nobody.
yeah, exactly. Whereas if the stock market went up by 15%, you'd be like, I would be, you would still be driven by, you know, what you observed in the year and a half before, which is like last whole year and this year, what you read in the news, right? So,
Right. Right. It would make those at the top leg of the K who are already doing great feel a little bit better, but it wouldn't really do much for the rest of the people.
yeah.
Um, okay, here. So it's good to hear though you're not your base case is that the unemployment rate will slowly come down over the course of the year, if I heard you correctly.
No, my base case, which I see reducing. So I attach maybe 50% to my base case. And the rest of the 50% is split between unemployment rate going down or going up. But
Hmm.
my base case is that unemployment rate would stay at 4.6% throughout this year.
Oh, okay. And you said stay at 4.6%. Aren't we're at 4.4 right now, right? So would that actually be a little increase from here?
4.3. Yes, it would be
4.3.
a
Okay.
bit increased.
Okay.
Sorry,
All
I mean,
right.
I say stay because that was our outlook that we entered the year with. But of course, that the most recent unemployment print did lower the chance of that, our
Yeah.
base case.
Okay. All right. But just again, high level, I mean, historically, 4.4, 4.6 is actually not that bad. But it's a market, as you were saying earlier, that people don't feel that confident about, right? Quits rates low. People fear that if I lose my job, it's really hard to find one right now, right? So it sounds like you're not saying that you expect a ton of improvement upon that this year. And you mentioned AI productivity. Um, Maybe it won't manifest so much this year, but what is your thinking about as AI really begins to increase the productivity across the corporate fleet? Does that, in your models, is that forecasting into fewer jobs?
Well, you know how economists think about labor productivity. We think that labor productivity improvement, while it decrease the jobs, um, you know, for the industry, eventually it should be expanding their profit and firms should be hiring more. So at the end of the day, it should be a net positive for employment. But the question is, between when the AI reduce the need for hiring to that the end of the day increased profit leads to more hiring, how long does it take? There is this transition period, and that is what I think this year would be like. We would be in this transition period where you are still seeing a net negative drop hiring needs from the boost on productivity from AI. And then only down the line, perhaps to 2028, in that election is when the net positive. If economists are right that ultimately productivity shocks always expand employment, then you would see that positive effect in 2028. I just don't think that 2026 we're there yet this year.
Right. Okay. And I'm just going to ask you to prognosticate here. So, just
I
the audience should.
prognosticate all the time.
Okay,
So
but the
that's
audience
what
should
I
know here.
do.
I'm just asking you to make a wild guess.
Yeah.
So you probably saw the headline the other day. Microsoft's CEO of AI warns that most white collar jobs will be fully automated within the next 12 to 18 months. So could it be different this time? Meaning, you know, people get displaced by technology, but then profits go up, and instead of getting rehired, well, the AI is just doing the jobs that those people would be rehired for. So, is there the potential this time that there's just people get displaced and it gets very hard to repurpose them because AI, as more time goes on, is just doing more and more jobs across the whole stack and across different sectors of commerce?
You know that shape you just described as the contour of how a productivity shock affect employment, the S shape.
Yeah.
That is a historically robust empirical finding
Hmm.
across hundreds of years.
Yep.
So I still think that it's hard to. I don't. I don't think there's enough information for me to say that this S shape will no longer be an S and rather it will be an L or, or whatever shape that is, a
Yeah.
U or V. I think it's an L, right? L shape. Um, because so I work in a large company. We also have been conducting analysis on the earning season. We read about how the S&P 500 firms are talking about AI adoption, and I think this lived experience, how it informed my own thinking, is that AI helps speed you up and it also replaced those people who conduct repetitive tasks.
Hmm.
So it frees up time. So now I think across all the major companies in the US which have invested in AI, they are directing their labor force to use AI. It's like mandatory. Now, even in the earning transcript, I see a lot of mentions like last year is when that you invest in AI. This year is when you kind of impose upon your workforce to use AI.
Right. Start
And then,
applying it.
yeah, and then the people who won't be using AI would be the ones who are obsolete. So you kind of, it is freeing people to do more of other thing else. So for myself, for example, it's supposed to increase my production because I'm spending less time on these other things, and it is supposed to actually increase the production. So I think
Yeah.
that's what all companies are trying to achieve right now.
So look, I would love for these concerns to be overblown, and I'm coming fresh off from having talked to some people in the industry about agentic AI and how fast it's improving. And
Yeah,
agents are essentially virtual people, right?
yeah,
Go do these tasks for
yeah,
me. Um, uh, it does make me wonder if it is different this time because yeah, if everybody's getting freed up, I mean, it doesn't mean that the work expands at the rate that people are being freed up. And if you're at the top and you're looking at the profit margin, it's pretty easy to start saying, I just don't need that many humans because I'm having more and more agents who can do a lot of this stuff. And of course, you throw in robotics in there where anything that requires a physical element, well, you put an AI brain in an Optimus body, of course, one generation 1.0 might not be great, but generation 5.0 might be amazing, right? So
yeah, yeah,
it is not
yeah,
hard to realize that or to get to a
yeah,
point of conclusion that like we just might need a lot less people. And of course, these things
yeah,
don't they don't take vacations, they don't require health insurance. Their
yeah,
cost will
yeah,
continue to go down over
yeah,
time, unlike humans whose cost goes up over time.
yeah.
So I don't know.
No, I agree with you. I hear these anecdotes too, but I think one aspect about being a human being that separates you from an AI agent is that human beings have agency. So when you feel like your job is under threat, a normal human person would be trying to make him or herself useful. So it pushes the boundary, like you
Mhm.
better come up with something new for yourself, if otherwise you are obsolete. And so and human creativity is what always lead to, uh, uh, which that always is the reason that prove these hypotheses of um, productivity boom replacing human wrong uh, in the past as well.
Okay.
It's kind of like, the Malthusian trap. Like the idea is
Sure.
that, oh, population growth is eventually going to lead to this, overuse of resources and then boom. But then in fact, what happened is that as people feel the pressure and some kind of negative pressure, they're going to innovate in order to get out of that trap.
Right. And we have plenty of examples of that. The peak oil fields fears being a good
Exactly.
example that drove us to fully
Yeah.
tap shale and we had
Yeah,
the shale
exactly.
revolution.
I would even say that applies loosely to thinking about fiscal sustainability too. I mean, how many years have we talked about how the US debt to GDP ratio is not sustainable?
It's going to crush the country, and yet
Right,
we
right,
always
right,
find
right.
ways to pull
We
more
find ways
cushions out of
to
the
it's
couch.
the GDP, nominal GDP growth to keep growing. And so if you have that innovation and that productivity, you would grow the denominator and then somehow you would stabilize the debt to GDP growth.
Okay. Well, please don't let me talk you out of that optimism, and I hope things go the way that you're hoping they will. Um, Kind of a related question. What's your general outlook looking ahead, say the next decade or so, in terms of
Next decade.
AI's impact on the economy? Do you foresee kind of a material additional GDP growth factor because of AI?
Wow, 10 years. But you know what? 10 years is
I was just
the
trying not to lock you into 2026, so you can do whatever period you want. Yeah.
10 years is like 5 to 10 year is what, a typical academic paper on productivity would tell you is the amount of time it requires for a technological shock to
Yep.
really improve employment and productivity. Um, I think that uh, I do agree that AI is different in the sense that it severely compressed the amount of time it takes for this technology to be uh, permeated through adoption in the economy. I think it will be less than 5 years. I would even say even 2 to 5 years, and we are already in year three, you know,
Hmm.
right now. Um, so I'm actually more concerned about um, the impact of AI on labor versus capital share. Um, I think there are some charts floating around. Everybody's circulating these charts showing that the labor share of the US economy has been steadily going down for
Sure.
years now, and capital share,
Decades.
yeah, decades, and capital share is going up. And that's kind of like broadly consistent. Or AI would even be amplifying these trends. It's because if you think about what AI is, it's like investment and it reduces the demand for labor. It boosts the profit of a company
Right.
and
And
therefore
it boosts
equity.
labor's profitability, which is great if you're employing people.
Yes, yes, but mostly it boosts the equity shareholder because the
Right.
profits will be reinvested in capital.
Exactly.
And so you could see this the labor class versus the capitalist. You could I could easily see rising inequality, and in five to ten
You mean
years.
further rising
Yeah,
inequality, right? Yeah.
further rising in inequality. And inequality is the kind of thing, and also fertility rates. So also
Hmm.
because many people are, especially young people who are just, in the beginning of their career, it's now harder to find a job in the bar as AI automated the low value job, the bar to employ a fresh college worker would be higher.
Right.
So that would disrupt a whole generation of young people, not only in their lifetime income, but also their household formation
Formation.
decisions.
Yeah.
And so when you talk about 10 years is where these fertility rates started, matter. You will see the impact of fertility rates
Yeah.
on everything.
Which
Um,
are already have already declined to really concerning levels.
right, right. I think it was CBO who published this demographic report that showed in 2030 is when the uh, the population in the US would actually be reducing, would be going down. And now suppose that AI and the disruption to the lives of this new, younger generation in the age 20 now, 20 to 30 is peak household formation years. And these guys, because they don't have a steady job or it's harder to get a good job, they delay that decision. And that will really disrupt by 2035. That will start showing up. And Bill Gross, the bond
Yeah.
king from
Former Bunkin. Yeah.
BIPCO, he actually wrote a book. Uh, he wrote it in 1990s, and there was a chapter about what is the one statistics that he would want to see if he were to be stranded in a remote island after 5 years, like in order to get up to date about the market is demographics, because the when you have a higher share of population in their 20s, 30s, and 40s, you also get a better stock market because consumption is also stronger. So
Sure.
I
And you
I
get a lot of
think
producers out there.
yeah, yeah. So I think this the AI boom, even as it increased the capital share and the profits in the short term, when you look in the longer horizon, it's then you need to take into account what is the net social impact of
Yeah.
AI, like on household formation decisions, on population trajectory, and not to mention politics. So if you have a newer generation, the generation of people in their 20s and 30s who drift into either side of the ideological spectrum because that could really influence politics, which have a second order effect 10 years later.
Hmm. So let me ask you this, and I got a bunch of questions. I'm just going to have to push to our next discussion here because we're coming up on the hour. But
Yes.
on this topic, and I'm going to really ask you to speculate. Um, do you think we get to a point where we see where we're headed, the abyss we're headed into societally? Because let me put it this way: um, do you see the current trends continuing? And if you continue them, we basically end up in a aristocracy, if you will, where we have a small number of elites that own everything, right? These are the folks that own capital. And then everybody else at the bottom is basically just a serf. I've used the term, if the K-shaped economy continues at the rate it's going to metastasize into a lower I-shaped economy where you have a little dot where it's the folks who are doing great and then everybody else is the stick getting left behind. Um, So do you think it's more likely we get to that stage, or do you think somewhere along the way we look into the abyss and say, we got to solve this and we come up with some way to not get to that unfortunate end?
There was a economist hundreds of years ago who predicted that kind of trend you just described, Karl Marx.
Hmm.
So that's exactly what he said. He thought that the capital share, the capitalists would gain a bigger share, and the proletariat class would get a smaller share until, and this is where his forecast came from, that the proletariat class would rise up against the capitalist class, and that was the rise of communism, right?
Hmm.
Because of extreme inequality. So when a society is pushed into this extreme inequality, Karl Marx's prediction came true, unless you do something about it. So I think in a democracies that we like America, the thing is we have regular elections, and so it keeps these inequality, extreme inequality in check, because if there is extreme inequality, then I suppose that a party who would favor universal basic income would win, and then they would impose universal income.
Okay. And maybe confiscatory tax policies and things like
Something
that.
like that to
Yeah.
attenuate
Right.
the
So
impact.
we get a President Mamdani type era where,
Yes,
yeah.
correct. You would
Okay.
probably get more of that if
Yeah.
AI severely disrupts the labor market.
Okay. All right. Well, look, Anna, thank you so much. I've got just one more official question to ask you, and then I'll do my last question, which is where should folks follow you? This is unfair to have waited until the very end to ask you this, but general market outlook. Do you have a sense for this year? I know you shared one scenario where the market could get pretty dicey if the bloom really falls off the AI rose. But do you have sort of a general sense of what you expect from this year, given the conditions we've talked about?
Yeah, as I said earlier in this conversation, I came into this year bullish, but now there are these policies coming from DC, coming from the White House, that are inserting cracks into this bullish thesis. And I think a big variable is which Kevin Warsh are we gonna get? Are they serious about trying to reduce balance sheet? If they are, just a little suggestion of trying to reduce the balance sheet could lead to a tantrum in the market, in the bond market. Like in 2013, when Bernanke, just hinted that they're thinking about reducing the balance sheet gradually, and boom, you get a big market
Yeah.
adjustment. Now, maybe Warsh and Bessent will form a great team, and they could come up with a Treasury and Fed accord that could effectively and precisely communicate exactly what they desire, and all the pieces will fall in place. It is a it is a very it requires precise operation. And I think the risk is high that they will not succeed if they even try. So I think the risk is that more volatility in both sides, in both ways. And for a portfolio manager, I'm not a portfolio manager,
Right.
but I'm sure a portfolio manager would see ne look at the situation now versus 2 months ago, would say that the volatility on either end are higher. So you should be doing more risk-adjusted expected value kind of scenario to think about how you should adjust your portfolio.
Okay, great. And we'll have to leave it there. I'm sorry to for everybody to have left that question to the end, but totally understand the answer there too. And we're already seeing higher volatility so far this year. All right, Anna, most important question for folks that would like to follow you and your work in between now and your next appearance on this channel, where should they go?
So if you have a Bloomberg terminal, then go on the terminal and type BECO go, and that's where the landing page for an analysis. And you could also follow me at Anna Economist on Twitter.
All right. And as usual, when I edit this, I will put up the directions on how folks can go to BECO BECO and go, and then your Twitter handle
Yes.
there. Folks, the links will also be in the description below this video as well. Anna, it's always such a joy to talk to you. Thank you so much for making time for us, especially on sort of such a busy and chaotic Friday the 13th. But you did a phenomenal job, and very much appreciate your work. I encourage everybody to go follow you. And hope you have a great Valentine's Day and look forward to seeing you maybe in Q2 at some time.
Yes, thank you, Adam. Always a pleasure.
All right, well, now we're at the time of the program. We bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined today by John Lodra. Mike Preston is out this week. Hey, John, great to see you. Thanks so much for joining. Let's dive right into it. Just an insight-rich, packed conversation there with Anna. Let's hear any of your key top takeaways, and then let's talk about what the market's been up to.
Hello, Adam. Great to be with you. That was a very good chat there with Anna. I really appreciate her comments. You know, we here at New Harbor, we're all about managing money for clients. So we live in the world of markets, and we often will say, and I know you very much say this yourself, that the economy and markets are not one and the same. So it's sometimes, and we do follow a bunch of economists, and Anna's one of them. We really appreciate her takes on the economic readings. But we have to work really hard to disconnect our brains from the economic headlines and the forecasts even, and what the markets are doing. And that's why we really drive our process primarily from market signals. But the economic backdrop is one that we certainly factor into our broader kind of landscape of possible scenarios. And she is, as I said, among one of the handful of economists that we regularly read reports from. So I appreciated her comments. You know, a lot of talk about AI that's been on the headlines in every which way for the last couple of weeks, and not just on the headlines, but it's had some like a firing line execution style march through different sectors, and different sectors have had you know, sudden sell-offs and panics, and we can certainly talk about that. You know, interesting. Bloomberg itself is not immune from this. You know, many folks might know that the gold standard for economic and financial data terminals is the Bloomberg terminal. It's a a standalone terminal, costs a pretty good chunk of change every year to subscribe to. But there was on Twitter or one of the social media spheres, there was a article about a guy who basically used a coding agent, like a Claude type agent, to basically code what he termed a competitor to the Bloomberg terminal. Now, there were some criticisms in terms of the quality of the data that fed into it and stuff, but the point being the functionality and the kind of utility of that terminal. Some guy was able to dictate literally to an AI coding agent to build him a similar thing. So it's just a poignant example relevant to Bloomberg that some of the disruptive kind of things that people are talking about. And I don't know if this is true, but there was a headline that came across my screen that suggested that Michael Bloomberg himself has, as a result of this, kind of marked down his net worth. I don't know if it's just rumor or not, but it's the point being, it's there's all kinds of stuff that are running through headlines and markets related to this AI thing. I'll just comment, in a broad brush, Anna projected a positive bullish take on the economic picture, and she outlined a whole bunch of stuff there as to why. I would say our market signals are kind of in sync with that. Right now, there's been a lot of volatility of late, and there's been some kind of whipsawing in some of the very short-term indicators we look at. But zooming out a bit, there is very much a strong, powerful signal in kind of the market that suggests further advances ahead. What isn't making the headline news is how dramatic the underlying rotation has been underneath the broad indices. So I certainly can talk about that in greater details to what we're seeing and what we're doing. But that's my quick takeaways there. AI is the headline of the day. We might as well go out with some talk about that.
Yeah, I've been talking about that a lot in recent videos, so I'm gonna resist the urge to repeat myself and have a sort of a full-blown what could AI do to the markets here, John, discussion with you. But just in terms of the things that Anna was talking about, I want to make sure on people's radars is, hey, to the point I've been making recently, like, don't be shocked if this year ends up seeing higher than expected economic growth, but the markets don't perform the way they have for the past 3 years, which has been extremely generously Again, who knows how this year is going to turn out, but I'm just telling people, just reserve some space in your head, for that to be the outcome. Um, Anna's job really is, economics, really forecasting, where things are headed. Her track record is pretty good, especially over the recent years. The fact that she doesn't see unemployment really getting that much better this year, I think is a really important takeaway, for a whole bunch of things. Certainly, as we were talking about with the midterm election, I have a hard time seeing, um, uh, people feeling any better about their personal economic situation, unless the employment situation improves notably from here. And it doesn't seem like Anna thinks that it's highly likely to. So I think that's a big takeaway from this. Um, and even though Anna's team went into the year pretty bullish, and I'm totally understand the reasons why. The fact that as we're getting some additional data here as the year, we're now month and a half or so into it, is making her a little bit more concerned, making her, maybe take a little bit of the enthusiasm off that bullish forecast. I think that's very telling as well. So we'll see what happens from here. But of course, her big thing was, okay, look, market-wise, just expect a lot of volatility. And that's where we seem to be, John. So, it's been another down week for the markets, I think, compared to where they closed a week ago. We're still seeing software and the hyperscalers struggle, which is strange just because we were so used to that being a one-way elevator, which is the way it's been for the past 3+ years or so in the markets. How concerned is New Harbor getting at this point, if any, that this is not necessarily a consolidation and sort of a temporary rotation to take the froth out of big tech, but maybe more of like a sign of a topping out that would precede a rollover?
So our indicators, so the weakness has been very isolated. As I said before, it's kind of been like this firing line execution of certain targeted sectors. First software, then like last week, financial services stocks sold off on news that Altruist launched some new AI tool that's supposed to do all kinds of whiz-bang tax planning, financial planning, and Schwab and a whole bunch of other financial service firms sold off pretty hard on that. Just yesterday, the transportation and logistics sector sold off really hard on news that this company called Algorithm has this whiz-bang AI generated logistics tool. And you have to chuckle because, and I don't know the tool, maybe it's great, but this company is like a penny stock, and their main business is selling, I believe, karaoke equipment. So it's
No
like,
way.
yeah.
Okay.
So
So we're getting to the point now where you just mentioned AI in your business model and the market
yeah.
runs with that. Yeah.
Exactly. And I want to share a chart, and I want to give due credit to. I came across this chart yesterday. I thought it was really a fascinating look at things, is just to some of the dynamics. So this is a chart put out by the Compound, and data from Bloomberg. But what it shows, so the blue line is the drawdown from peaks of the S&P 500. Okay. And the red dots signify any point where the 8-day rolling count of stocks that are down 7% is greater than 100, greater than equal to 115. So of the 500 stocks in the S&P, anytime that the 8-day rolling average of 115 or more of those stocks being down 7% from peak, that's where a red dot is. Now you can see some of the most prolific sell-offs in history, the tech bubble, the housing bubble, were littered with these red dots, right? And going back over history, this history anyways, going back to 2000, the average drawdown in the S&P with those clusters of things, these red dots was is 34% drawdown. So here we are now, we're registering one of those red dots, and the S&P, and this I think chart was maybe a day or two ago, so it's not necessarily as of today, but the point is still the same. The S&P was only 2% off of its high. So you have these serial executions of these specific stocks, but the broad indices are hanging in there. Now, so in our indicators suggest that there's not a broad weakening. There's very strong breadth. There's some rotation, very profound rotation going on. I'll talk about that in a second. But so far, that weakness hasn't cascaded. Now, the emphasis there is so far. If you look what happened back in the tech bubble, that same thing started that way, but it turned into a pretty vicious sell-off. Over 50% decline in the S&P and over 80% in the NASDAQ. Now, could the back then it was, well, suddenly the market started saying, well, hey, maybe mouse clicks aren't enough to justify the valuations that we've assigned to these internet companies. Could this be the start of the market starting to say, well, maybe all this overhype of AI is not enough to assume these earning margins are going to continue forever. And the point I'd like to make is that the markets are combined of two things: earnings expectations and the multiple that the market is willing to pay on those earnings. Um, and you can have the earnings come through just fine or barely dented, but if the market perceives a greater uncertainty, they may just re-rate the multiple down. So you could have these things sell off further and stay down, not because any great erosion in earnings, but because the multiple that the market is willing to place on them suddenly comes back to some closer resemblance to gravity versus the current heights. Um, I'll pause here for a moment, but I did want to kind of show you some of the sector rotation that we're seeing and trying to kind of rotate our models to adapt with.
Yeah, all right, well, let's go there. So that has been something that we've been talking about in a lot of your recent previous appearances here, which is that, capital is rotating out of the mega trade that had dominated for so long into some other sectors. And I think sort of the open question is that temporary, right? Is capital just going to flow out until, multiples come down a little bit more in the tech space, and then capital will flow back in because there's now better valuations there? Or is this more of going to be a secular theme for 2026?
Yeah, so let's talk about that. And let me just pull up. I have a table I put together here just showing the year-to-date performance for different sectors, and this is through February 12th of 2026. And then I compare it, with what those sectors did in 2025. So you look right at the top, you have energy, you've got materials, you got gold. There's a theme there: commodity, real tangible things, right? Old school kind of industries and things. Towards the bottom, of course, you've got software, which has absolutely gotten slaughtered, even more so than the broader tech industry, which is self down on the year, the whole tech sector. But software in particular has been particularly weak. Bitcoin is one of the weakest things this year. So you compare those actions here to some of the highest performing sectors last year are the weakest performing sectors this year. So communications, technology, financials have really been weak here. This is usually financials being weak is not a good sign for the overall market. So who knows what that may signal, along with the tech leaders starting to kind of falter here. We'll certainly watch for that, but that's something that's got our radar up. But you look at many of the things that we rotated out of financials, for example, fourth quarter of last year, and we rotated into material stocks and energy. Those stocks have continued they did very well in the latter part of last year. Not, during the course of 2025, they didn't do great. Look at the energy sector was only up 4.4%, lagged dramatically the broad indices. But over the last quarter and so far the year to date, very strong. So we think these are early trends. I'll talk about that in a second. But also, I just want to call out that we're seeing a broadening of the market. So, for example, the equal weight S&P 500 index is up as of February 12th, nearly 5%, where the cap weighted S&P 500 is down slightly on the year.
Yeah,
So we're
and
seeing
that really shows you that it's rotation. It's
Yep.
just rotation to other sectors. Yeah.
Broadening out. We're seeing small caps. And once again, you're seeing non-US dollar assets, emerging markets, and even developed foreign markets strongly outperform developed markets. That was one of the themes that carried through from last year, as did the precious metals. Precious metals are still up strongly this year to date. You can see gold was up 14%, even despite the recent massive sell-off and volatility, and it's up further today. So some of the themes of last year are carrying through very strongly into this year. Just quick note on you asked about secular or temporary. We do think there's a very strong secular theme here that will probably carry commodities, broad commodities, not just talking about precious metals, but I'm talking about energy commodities, agricultural commodities, base metals, things like that. This is a chart. One of the, I think, very best commodities research shops out there is Gehring and Rosenzweig. They do some great work. We follow their work. This is a chart they put out. It's a little dated now, but it makes the point that relative to the Dow, commodities are tremendously undervalued. I'm sorry. So you can see multiple years of a cyclical trend there, higher in our opinion. Just glance at this. This is a chart a little bit dated, but it makes the point. What we've seen in the material sector is just really a lack of investment in productive capacity for new production. You go back to 2011, 2012. This is the capex across different commodity type of industries. It was way higher than it's been any part of the last decade, and the trend or the forecast was for declining investment. And you see why. I mean, this is a little infographic on copper discoveries over the last century or more. The size of the circles here are meant to demonstrate the size of the proven reserves, and where they are in the vertical part is how deep in the earth they are. So you can see as we've gone over time, the circles have gotten smaller, the reserves have gotten smaller at each of the discoveries, but the depth of mining to get those reserves has become impressively deeper. So, increasing demand not only from, electrification and the AI boom, but also you have resource hoarding going on by governments, trying to build up their stockpiles, realizing that it's not healthy to be dependent on other countries for critical materials. These are all things that we think will drive a secular trend. There certainly will be there'll be pullbacks along the way, but we don't think we're late in this stage of this cyclical move in commodities.
All right, do me a favor if you can. Can you pull up the commodity chart that you showed just two charts ago, the one from Gehring and Rosenzweig?
Yep.
So I just want to show two things about that. One, when in the past, which has really only happened twice, right? When commodities got this undervalued, the recovery has been very sharp, right? And this is largely due to the fact that you usually get into shortages of some sort, and the market really tightens up, and that's when prices, tend to really move, and they move fast. So this is sort of an argument for if this is an opportunity you're trying to seize, you better to be early to it than late, right? Because if you're too late, you've missed a lot of the price movement. Now that being said, look at the period there in the center, from the 1953-ish to 1973. That's 20 years. So these troughs can take a long time. And there are a lot of people that I know who, to a good extent, myself included, who sort of have been looking at charts like this and have been buying commodities for a long time, and yet they've been undervalued for a good while here. This could last a lot longer. I don't necessarily think and hope that it will, but I just have to be open-minded to the fact that it could take longer than I want for this to get out of here. Now, the only other thing I want to mention too is this is a ratio. So yes, if commodity prices are going up, that's going to raise commodities from undervalued and start moving it higher. But also, if the Dow corrects, that will also move this ratio higher. And what will probably happen is some combination of the two here, I would imagine. So, this chart does spell a lot of opportunity. I don't want to dismiss that at all. I'm just saying that it could take a while for the opportunity. It could take longer than you may think for the opportunity to materialize. When it does happen, it's likely to be pretty fast and furious. But also, I personally think we'll probably get a pretty big bump here out of the commodity complex when this happens. But it could be a muted one if the Dow is what ends up correcting more. So you just have to be open to all those factors.
Yeah, Adam, I'm glad you raised that. It was actually the very point I was going to make. To your point, this is partly a function of how overvalued the equity market is. The perfect example of that, though, is the tech bubble in 2000. We know the market was very overvalued, and you saw what happened here. The market sold off very hard, but commodities also did very well. So it's to your last point, I think exactly is what you just said is likely, that you probably have this ratio moderate by those two factors working together. the equity markets selling off broadly and commodity prices, relatively speaking, outperforming.
Okay. So, John, last time we talked, you and Mike clarified that, New Harbor is, um, you're feeling pretty good about the market health in the sense that you're not de-risking. Uh, you are, I mean, you still have a healthy cash balance because you have some general concerns about current valuations, but just looking at the immediate road ahead, you're not like seeing signs that the wheels are coming off. Um, of your equity exposure, I believe you said more than half of it now, maybe if you take the mining slice out, is in international markets versus the US market. Is that true?
It's not quite half. We have, not including gold mining stocks, which we have about 10% allocation to. Our equity allocation target model allocation is 47.5%.
Okay, close to half.
Yeah, and about 20% of our equity exposure. So, 20 out of 47.5 is non-US equity exposure. So pretty healthy, greater than market weight, I would say, weighting to non-US stocks.
Okay. And of your equity exposure, you have a material percent of it in commodity producers, et cetera, these sectors for all the reasons that we just went through.
Yeah, we have a systematic, we use a relative strength sector rotation kind of element to part of our strategy, and that is what led us into some of these sectors. For a long time, for example, we've been saying that energy and basic material stocks were undervalued, in no small part because due to some of those charts like we just looked at, the Dow to commodity ratio, but the relative strength was lagging, and we held off jumping into those sectors until the technical started to improve in a way that suggested that the baton was being carried by those sectors. So yeah, we do have a pretty good weighting in those sectors, and it's been serving us pretty well here.
Okay. Have you made any material changes to your main portfolio lately? And whether you have or you haven't, what's on your current list that you're looking at in terms of decisions you expect or are hoping to be able to make soon? Like, oh, this is a sector we want to buy because prices are getting more and more favorable, but it's not quite there yet. Or on the flip side of that, here's a defensive measure we're thinking about taking, but we're only going to take it if key indicator X starts blinking.
Yeah, well, so we, the technology sector, we have an equal weighted ETF in the technology sector. It's been our weakest sector, no surprise, and it's starting to get into the territory where we have to start asking ourselves whether we should be rotating out of that. Other sectors have started to exert some strength. Consumer staples, the classic defensive sector, has been a laggard for a long time, and it's seen a pretty massive breakout, a little extended, frankly, in the short term here. So we'd probably be patient to enter something like that. But you're starting to see value names start to kind of creep into, kind of the dashboard as showing relative strength. So those are the kinds of things that we probably would anticipate maybe our next moves, but we're not quite there yet. And we probably, if we see some further strength here to the upside, certainly if we start to challenge recent highs or take them out, that'd be a prompt for us to, especially if we get extended, think about selling some call options to bring in some premium.
Mhm.
Those are the kinds of tools that we're thinking about near term, deployment. But we don't call the plays until they're time.
Got it. Yeah. And I do want to say that your firm's use of options, as a hedging technique or a way to reduce risk, the way in which you deployed them during the precious metals, vertical explosion there, I think was just a real reinforcement of the prudence of why you guys, use those tools at your firm. In terms of the precious metals, as you said, they are, I mean, they're still doing quite well for the year, even despite the pretty rough correction that they had. Gold is up over 5,000 an ounce as of the time we're talking here. Silver, I think, is around, at least silver futures is around like $78 an ounce right now, which is disappointing if were one of the few that bought in at $122 an ounce or whatever top it made there super briefly. But you're doing great compared to where the price was 6 months ago. So hopefully no one's shedding too many tears there. But they're I think the jury's still out, quite frankly, here about, whether we're gonna see recovery to new highs or whether, this is a pause and a larger corrective event from a massive blow off top. I'm more worried about silver right now than I am about gold. Um, how are you guys looking at it all right now?
Yeah, well, first it comes down to position size. You don't want to have too much of anything. And many folks, even with the recent sell-off in precious metals, have ridden these things higher over the last bunch of years where they may have, 40, 50, 60, 80% of their portfolio in precious metals. Absolutely, it's not too late to shift back to reduce exposure there. There can be too much of a good thing. Our target allocation for clients is 12.5% in the accounts that we manage for them. We oftentimes suggest folks think about maybe having some physical metals outside of their investment accounts, 5 to 10% in physical metals. But our target allocation is 12.5%. We're very comfortable with that. I do think, and I'll just pull up a chart of SLV, which is an ETF that tracks silver. This is what the daily chart of SLV and silver look like. I mean, that no matter how bullish you are on something, that's not a healthy ascension. That was a really blow off toppy kind of, and frankly, as you just alluded, we had hedges in this, and the consequence of that is we didn't enjoy much of this last gasp, rise in silver for our clients. But when this 30%, nearly 30% daily drop happened, our clients were all but unaffected on the silver slice that we had hedged because we had very deep in the money call options at that point. And what we did on this pullback, it enabled us to push those call options up. So right now we have call options on SLV. We have a 2.5% position in SLV. We have call options struck at $75 strike price. So they're essentially, just out of the money. There's still some really, really rich premium, but all this volatility that we've seen here lately has been pretty nicely offset with those call options. So for example, just yesterday, I think silver was down about 10%. Um, our call options basically cut that volatility in half on the folks that we could hedge with options. Doesn't take risk off the table. It just greatly mutes them. I do think that precious metals will go higher longer term because of the structural regime we're in with, kind of the fiscal and monetary kind of trains that have left the station and probably aren't going back. But I do think we're not going to see a quick return to these recent highs. I would not be surprised to see continued very sharp volatility here in the near term, but over time, I think we will regain a trend higher. But can't urge people enough if you got a sizable position that's, just objectively too large, absolutely think about scaling back. Use the money, convert it into dollars to live with. Go travel, go put an improvement on your home, whatever the case might be. After all, that's what this whole reason for holding precious metals is. It's basically to hedge the purchasing power of your dollar, so you can affect your life in a more kind of impactful way and hedge against things like inflation and stuff like that.
All right. Well said, John. I want to ask you about Bitcoin in just a second, but real quick, just on the precious metals, I want to remind folks that if you are, I want to remind folks that the offer that Andy Schectman, CEO of Miles Franklin, has extended to the Thoughtful Money audience as an exclusive offer has been to buy junk silver from his firm at 99 cents above spot, which is a very, very low premium relative to historical premiums. And he extended that offer while supplies last. As he mentioned, I think in his last appearance, he had bought a lot of junk silver. So supplies are still lasting for the time being. So if you want to take advantage of that, or just ask him and his team any questions you might have about buying, selling, storing gold and silver, just go to thoughtfulmoney.com/buy gold, fill out the very short form there, and the Miles Franklin team will be in touch with you right away. Okay, so John, I know for a period of time, at some point, I think in the last year and a half or so, the New Harbor team did add Bitcoin to its portfolio for the first time. I think you guys did sell out of that at some point last year. I'm sure you've been watching the action there in Bitcoin. It's down almost, I think it did get down to about 50% of its all-time high in the recent weeks. It's sort of struggling still right now, I think in the mid to upper 60s. you probably saw the post that Michael Burry put out there that talked about the potential that he saw for Bitcoin to kind of become this vortex that pulled other things down with it if it continued to go lower from here. I'm just curious, do you guys have an opinion on it right now? Because there's a big debate going on right now as to, hey, yeah, there's a lot of risk out there this time. And boy, if it goes down much further, then firms like Strategy, Bitcoin Treasury companies like Strategy are going to have to start selling their Bitcoin, and that's going to add downward pressure, plus just be very optically disruptive. And other people saying, look, this is just a regular Bitcoin halving, and it's getting to be a good value. And if you wanted to get into Bitcoin, this is a good time to buy in. Do you guys have a strong opinion one way or the other there?
So I'll just quickly, we don't own Bitcoin right now for clients. We did own it very briefly in 2024, I think it was now actually, through an ETF, and we added a 1% position, and I want to emphasize 1%. And we sold it pretty quickly. I think we held it for a short number of weeks or months. It wasn't very long because we saw, and it was a technical trade that we did. And we haven't been in Bitcoin since. I personally don't own Bitcoin. And that's not necessarily to say good or bad. It's just a reminder that successful investing doesn't mean you have to be in everything that works. You got to be in a strategy that works, and it provides what you need when you need it, and it can grow your assets and protect them when they need to be. Bitcoin in its genesis, I think, has a lot of merits. I mean, we've been long proponents of precious metals, gold especially, for a lot of the same reasons that Bitcoin came to be.
Right. Those
Now,
sound money
personally,
reasons.
sound money, yeah, and the blockchain technology, broadly speaking, is I think an earth change, a very transformational technology, and cryptocurrencies, and Bitcoin being a cryptocurrencies, just one use case of the blockchain. My son just had a car accident, and his high mileage car got totaled. My name was on the title, so I had to sign a title release, and the RMV had to send it back to me because and we had people, humans in the office doing this. Because I signed slightly outside the box that I had to sign in, they sent it back to me, and I had to re-sign. And I'm thinking this is a perfect case for like blockchain technology, title tracking. It's a distributed ledger. It's accurate. It's fast, efficient. So it just reminded me how transformational blockchain technology could be in things like titling of assets, real estate, and otherwise. But here's the thing. I mean, ultimately, the price behavior, just looking at gold, for example, and I know folks will say if you look at Bitcoin versus gold since Bitcoin's inception, it's blown gold away, and that's a fair point. But we don't fall in love with anything. We think it's a great danger to fall in love with any asset. And if there's a criticism I have, generally speaking, by observation, is folks that are purists when it comes to Bitcoin seem to have a religion about it that I think oftentimes can cloud maybe judgment, not in terms of necessarily whether it's good or bad, but how big a position to have, whether to sell or not. I mean, there are some folks that say never sell. I mean, Michael Saylor, strategy is pound of the table. I'm never selling.
Yeah,
And
well, and not only never sell, but basically sell a kidney to
yeah,
buy
exactly.
Bitcoin.
And I don't know. I watched some of the earnings calls with Michael Saylor and some of the press releases he puts out in the video interviews. It's really shocking to me that a CEO of a public company talks the way he does in terms of promissory, grandiose, religion-like statements. It's not for me personally. Not to say that there is not a case, and we may not justify having a small piece for our clients again at some point. But our strong favorite is precious metals to check those boxes of sound hard currencies. And if you do go into cryptocurrencies, Bitcoin, just keep the position size small. If it's going to go to a million or 10 million or whatever the price forecast is, a small piece will go a long way to doing well for you.
Okay. All right, John. Well, look, thanks. We got to start wrapping things up here. I guess quick question for you. Any last bits of advice, either questions I didn't ask you or just things you're seeing with the people that you're talking to right now?
Just a reflection. Anna talked about humans having agency, something big AI can't or won't have. I like the word empathy. I mean, I'm just drawn to the conversations that I and the team at New Harbor have pretty much every day with our clients who are real people. These are not conversations that I don't think AI anytime soon will be able to have. So yeah, we're in some ways you could be scared about every industry, including ours, being displaced by, smart AI bots. But man, there's a human connection that certainly we have with our clients, and it's a real personal connection that I feel pretty confident won't get displaced anytime soon. Even if there is, I think this weekend, a cafe opening up in New York City where specifically made for people to go on dates with their AI partner. Um, I don't get it, but perhaps there's a demand for that.
Yeah, that depresses me so much. We wonder why our domestic birth rate is just at terrible lows. All right. Wow. Yes, and I very much appreciate not just the human touch that New Harbor gives to its clients, but the fact that, yeah, I mean, at the end of the day, you understand it's not just about numbers on a account statement. At the end of the month, it is basically people's plans and dreams and goals, et cetera, that you are trying to help them hit, but also, like you said, sometimes tell them, hey, you've got enough, and maybe prices are kind of rich right now. Like, take some of that off the table and actually do what you wanted to do with your life.
Yeah, it's a privilege that we get to sit in a seat. It's can be a hard job sometimes, but it's certainly fulfilling.
All right. Well, I'm glad you're doing it for everybody, John. Thank you. All right, folks. So in wrapping up, if you'd like to see Anna come back on in Q2, as I proposed to her, please let us know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help from a good professional financial advisor to help position your portfolio for the year ahead, especially if it ends up unfolding the way that Anna thinks it might, or you're concerned about some of the volatility that she recommended we all should expect. I highly recommend you get that help from, yes, a good professional financial advisor, but one that takes into account all the macro issues that Anna and I and John and I have talked about here. If you've got a good one, great, don't mess with success. But if you don't, or you'd even just like a second opinion from one who does meet that criteria, then consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses. Perhaps you'd like to talk to John and his team directly there at New Harbor. So to do that, just fill out the very short form at thoughtfulmoney.com. It only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments to work with these firms. It's just a service they offer to be as helpful to as many people as possible. And a reminder that the Thoughtful Money Spring Online Conference is coming up pretty quickly. It's just a little over a month away. It's going to be Saturday, March 21st. Don't worry if you can't watch live. Everybody who buys tickets is going to be sent replays of the entire event, all the presentations, all the live Q&A within just a couple hours after the event's conclusion. It is going to be amazing, folks. I mean, not only is it going to be looking like it's going to be really timely, given everything that's going on right now, but it is like hands down the best faculty that we've ever put together. We've got Lacey Hunt, and he'll be doing his traditional keynote with his graduate presentation that's always full of the charts that he brings. We'll be joined by first-timers Ed Dowd, Michael Oliver, and journalist Matt Taibbi. We'll have Luke Groman. We'll have Brent Johnson. We'll have, we'll have Judy Shelton. We'll have Danielle DiMartino Booth. We'll have Michael Howell on liquidity. We'll have Darius Dale giving the latest on his model. We'll have Stephanie Pomboy and Grant Williams. We will have Rick Rule. We'll have, did I mention Judy Shelton and Danielle DiMartino Booth? I don't think I did yet. We'll have Melody Wright. We'll have Andy Scheckman. We'll have David Hay. I mean, it's just an amazing brain trust that I'm banging down here, folks. It'll be over 10 hours worth of content. We'll also have John and the team from New Harbor there. So it really is going to be just an absolutely amazing event. If you'd like to attend it, go to thoughtfulmoney.com/conference to buy your ticket, and go quickly, because we want you to get that lowest early bird price while it's still available. And if you are a premium member to our Thoughtful Money Substack, look in your inbox for the discount code that I've sent you, because you can use that to get an additional $50 off of the price of admission. And look, if you want to game the system and just sign up for a month for the newsletter, which I think costs 19 bucks a month, and pocket the $50 savings, I'm totally happy to have you do that. I want everybody to get the lowest price possible. All right. Well, John, look, can't thank you enough. Great job this week going solo. Look forward to seeing you and Mike next week. We'll be able to talk a little bit about, speaking of conferences, Stephanie and Grant's special conference that they do annually. I'm going to that in between now and next week. So I'll hopefully bring back some of the highlights of that we can all talk through. But thanks again, my friend. Always appreciate having you guys participate in this.
Thank you, Adam. Very much appreciate it, and have a great time at the conference. I'm sure it'll be chock full. I will say your conference twice a year is well worth the price of admission. We get a lot of it out of it ourselves here at New Harbor because we get to hear from a whole roster of great minds, and it's chock full of makes the day go by pretty quick because it's full of great information.
That's great because it's a very long day, as you know. So I'm a competitive guy, and I try to compete with the other people that are doing these things by just trying to deliver overwhelming value for the price. And I don't know anybody that gives as much content as our conferences gives, but it's high quality content. And I've already listed through the names, so folks, you know the caliber of people we're going to have there. What I love about these conferences, John, is like clockwork. Every time Lacey kicks it off with his keynote, and then he comes on for Q&A. And then after that, in the live chat, I start seeing all these people say, well, that was totally worth the price of the conference right there, right? And they still have like 9+ hours left and everybody else.
Yep.
Yeah, so we do try to price it as the best value that's out there. So thanks. All right, John, well, look, I wish you and all the viewers a happy Valentine's Day this weekend. I'm actually flying solo. My wife is out of town for her father's 86th birthday. And I was down in the Bay Area earlier this week, so I took him out for an early birthday dinner. So we had to sort of divide and conquer here. But anyways, I hope everybody has a special somebody they can spend the weekend with while I am just sitting alone and lonely. And don't feel bad for me, folks. I'm kidding. I'm going to be just fine. My wife's coming to Stephanie's thing with me, so we're going to do something really fun when she gets back. But again, John, I hope you and everybody else watching has a great Valentine's.
Thank you very much, Adam. We'll see you soon.
All right. And everybody else, thanks so much for watching.